Alright, welcome back. This is part 5 of chapter 4. Okay, in the last clip we were looking at completing the forecasting for the balance sheet for 2019. Okay, so total assets increased by 10%. Okay, now we move on to the liabilities and equity portion of the balance sheet. The first item is payables. Okay, step number 4, this also increases by 10%, because this is a spontaneous liability item. This also increases by 10%, together with sales, in line with sales. Therefore, this 990 is 900 multiplied by 1 plus 10%. This is the formula here. Okay, so that is the first step on the liabilities portion. Then all the other items, look at this, notes, long-term debt, and common shares. These three items, they don't change, in the first step, okay, no change first, at first, no change, all these are the same values. You can see that these are all the same values, 2,500, 3,000, and 2,000, these three items do not change. Alright, now the next item is retained earnings. Okay, that is the next step. The formula to determine, how do you determine this value 3882? It is simply 3100 or 3100 plus the addition to retained earnings, or the retained earnings for the year, which is 782. This is taken from the income statement. So 782 plus 3100 is 3882. So this is the retained earnings. Alright, with that we finish this step number 6. Then step number 7 is this value here. Total liabilities and equity must be equal to total assets here. 12650. They should also be 12650 because they must be equal. There is no possibility of this not being equal. Therefore, if this is to be equal, then this total here must be equal to 12650. But you'll find that when you add all this, you'll find that this total is less than 12650 by 278. And this is the plug figure, meaning this, okay, and we term this EFN, or external financing needed. Okay, meaning this portion, liabilities and equity, you must have an additional $278 million worth. These are all $1 million, but just ignore the million, just assume that it's dollars. $278 in order for the liabilities and equity to be equal to the total assets. So this is required. Okay, and this is called external financing needed. Okay, so this financing policy is variable here. The the dividend policy is fixed. Alright, by determining this, 278 is the plug variable here, and the plug variable is external financing needed. Okay, so this amount, must is the shortfall. That means the liabilities and equity is less. The value here, we take the total value here, it is less than 12650, than the total assets, by 278. That is how you interpret this figure. Now this 278 shortfall must be made up. How do you make up? You can increase the notes payable. You can also increase the long-term debt, or you can increase your common shares. You have three options here. These you can increase. So in your second step, this first step, we assume that they do not change, right? You retain the same values. But in the second step, you can raise this, either one of the three, any one of the three, or you can increase all three so that the total increases by 278, and therefore this becomes 0. So when this becomes 0, then you have completed your liabilities and equity to be equal to your total assets. Okay, so that's the idea. Let's try this. Let's increase your common shares. Let's say the company, in order to maintain this balance sheet to be balanced, what it does is that it issues new shares. So let's say it issues $278 worth of shares. So we replace this with 2278. Yeah. Alright, so now if that happens, then this total will be 12650, which is equal to that. And of course, there is no additional extra financing needed or external financing needed. It's not required because this total now is equal to 12650, and that is equal to your total assets. Is that okay? So you can change any one of the three, raise this any one of the three by 278, or you can raise a little bit there, a little bit here, and a little bit there. Yeah? Any combination, yeah, is acceptable. Of course, if you change this, okay, if you change any one of this, okay, then you might change the capital structure. Yeah, capital structure policy will change, because if you increase this only and you leave these two, yeah, unchanged, then your debt in the capital structure, your capital structure policy will change. Yeah? You will be using less debt or less borrowing. Yeah. So this is the financial plan, and that's how you complete the financial plan. So from this, what can you say? Okay, in order to support this 10% increase in sales, you need 10% increase in assets, and this 10% increase in assets must be financed, yeah, with $278 of external financing. Yeah, and this can come from increasing the common shares by issuing new shares, or issuing new long-term debt, or issuing new notes payable. Is that okay? Right. Yeah. So we replace this. We make this. We make this equal to that. Yeah. In order to get back the external financing needed. Yeah. So this is how you do the financial plan for Tasha Toy Emporium. Yeah. Let's go back to the slides now. Okay. Alright, now let's look at this, yeah? Demonstrate this in terms of a diagram illustration. Yeah? Tasha's percentage of sales forecast. Yeah? Alright, so we know that this sales must increase, yeah, to 5,500. That's an increase of 10%. From this increase in sales, increased sales, you have net income. Higher net income, yeah, by an increase of 10%. Therefore, the new level of net income is 1304. Yeah? And the dividend policy is fixed here, so 40% will be paid out as dividend. That's 521. $782 will be retained. Yeah? And this is the internal funding. All right. Then then we forecast the balance sheet. Okay. This increase of new level of sales, yeah, higher level of sales of 5,500 must be supported by an increase in assets, yeah, an increase in assets of 1,150, yeah. All right, so this will also lead to an increase in spontaneous liability, which is 90. Yeah, we saw that $90 increase in spontaneous liability. This is accounts payable. Okay, this increase in assets come from both increases in current assets and fixed assets. Yeah. Then this change in assets must be equal, okay, to the change in liabilities and equity, meaning that the amount from internal funding and the amount from spontaneous funding and also external, yeah, the three sources must add up to be equal to this. Yeah. But you find that when you add these two elements, this and this, you find that this is less, yeah, not enough. Therefore, you need external funding, EFN, external financing needed from both debt and equity of 278. Yeah. So when you add these three elements, 782 here, 278 here, and 90 here, this will be exactly equal to 1150, which is equal to the change in assets. Yeah. So in order to, yeah, this diagram also demonstrates the same information, yeah, the same conclusion. If the company wants to attain this level of sales, which is an increase of 10%, the company needs to increase the assets by 10%. So it needs additional funding of 1150, and this must come, okay, from three sources. Yeah. The first source will be internal funding, which is $782 from earnings in that year, and $90 from spontaneous liability or spontaneous financing. This is from accounts payable. Okay, an increase in accounts payable, and another 278 must come from external sources, either using debt or equity. You can use debt or equity. Okay, so this is the idea. So this plug variable of 278 can come from borrowing more short term or borrowing more long term, or selling more common stock. So these are the three possibilities. But apart from that, you can also decrease the dividend payout. If you decrease the dividend payout, it is not an external form of financing. It's not external, but it's a way to meet your funding needs, additional funding needs. Okay, and therefore you can decrease the dividend payout by retaining more earnings. So when you have more internal financing, then you need less external financing. That's the idea behind this. Alright, with that we finish this second part, second key concept in this chapter. Now we move on to the third key concept, which is deriving the external financing needed in formula form. Note that we have used the financial planning using the pro forma method. Okay, and one of the reasons for financial planning is to determine the financing needed. Note this, this financing needed can be determined using the pro forma method. But apart from the pro forma, you can also determine the external financing needed by using a formula. So we are trying to derive this formula here. Okay, so in the next few slides we look at how this can be derived. So we start this formula derivation by starting with this basic balance sheet identity, which is assets equals to liabilities plus equity. We have seen this in an earlier chapter. Now what we are going to do is we expand this equation to include spontaneous and non-spontaneous items in assets and liabilities. So we expand assets into two components: spontaneous assets and non-spontaneous assets. Likewise, for liabilities, we expand into spontaneous liability and non-spontaneous liability. Then equity, like we did in the previous chapter, we divide this, or we expand this into two components. One is called common stock, the other is cumulative retained earnings, right? Okay, so we divide this into spontaneous and non-spontaneous because some assets change or vary directly with sales. That would be spontaneous. Okay, this includes current assets, except cash. All current assets we assume are spontaneous assets, except cash. Usually cash is not considered as spontaneous. All other assets, including fixed assets, these are considered as non-spontaneous. Okay, including cash. Cash and fixed assets are considered non-spontaneous, meaning they don't vary directly with sales. Liabilities, you have spontaneous and non-spontaneous. So here spontaneous, this will include accounts payable. Okay, non-spontaneous and other current liabilities. Usually other current liabilities will be considered as spontaneous as well. The only current liability not considered as spontaneous would be your notes payable. Even though it's short term, it is based on a deliberate discretion or decision by the management to take out a loan. Therefore, this cannot be considered as spontaneous. So non-spontaneous liability includes notes payable and long-term debt. Okay, this comes under non-spontaneous, right? Okay, then we can say that if equation 1 is true, meaning assets must be equal to the liabilities plus equity in terms of level. This is the level of asset, so it must be equal to the level of liability and equity. We can say the same in terms of the change in the level. So we just add this symbol of change. Delta here signifies change in each item. So the change in asset must be equal to the change in liability and equity. That's what this equation says. Alright, that's all we have time for in this clip. We'll continue next clip, in the next clip.